and welcome to Market Domination. I'm Julie Hyman. That's Josh Lipton, live from our New York City headquarters. We are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
It is very key that the one number that stood out was the year-over-year growth on e-commerce sales. That grew a robust 7%. So the fact that it grew 7% on top of a very strong prime week last year, it's telling us that the consumer is still gravitating towards those online deals. They're still being very price conscious and are only opening up their wallet for those discretionary items unless they feel that they're getting a value for their money.
I'm a little worried when Fed Chair Powell says there's no hurry. It makes me think they're a little bit taken aback by the speed of the Trump administration hiring people and talking about what they're going to do in terms of fiscal stimulus, spending cuts, et cetera, tariffs. Maybe they're a little bit worried, Powell, even though it's too early to judge what is ultimately going to come out of the new administration.
What happens with these picks is important. It's a different world if Republicans stand up and say no to Robert F. Kennedy Jr., no to Matt Gaetz at Justice, no to Tulsi Gabbard as Director of National Intelligence. Then I think people think, okay, then Republicans will have done that a couple of times and they'll be used to guarding the guardrails and exercising some power.
We got 1 hour to go until the market close. So let's take a look at the major averages, and this pause, or really a come down from the post-election rally, is continuing here today and intensifying at that. We got the Dow down 324 points, about 0.75%. The S&P down 1.4%. The Nasdaq, really the big loser today, down 2.4%. Something else I want to point out, Josh, is that if you look at this week here, we're down about 2.2% or so in the S&P. The worst week since September. If you stretch it out here to sort of look at the post-election rally, we've come almost all the way. We've almost wiped out those gains that we have seen since.
Yeah, I think the economic data was interesting today too, Julie. The October retail sales, tepid, hurricanes, falling prices playing a role here, but upward revisions to September, which would suggest, yes, consumer hanging in there, and yes, the Fed could slow down the pace of easing if so inclined. Yeah,
so switching on over to the 10-year yield, just looking at today and what we have seen, very little change there, but still 4.42%. We haven't really seen much relief on the yield front. And then, as I mentioned, tech is seeing a lot of selling today. Perhaps those two things are intertwined, right? Higher yields haven't consistently mattered for big cap tech, but they've mattered sometimes, right? And so we see a lot of weakness there.
All right. Well, moving on here. 2 years ago, a recession was in almost everyone's forecast and considered a near certainty by many. Today, the economy in a good place. Interest rates off their recent peak, but also off their historic lows, putting the Fed in position to respond appropriately regardless of how the economy evolves. And Julie, I'm stepping right into your...
That's all right. With Donald Trump set to begin a second term on January 20th and the promise of tariffs following him into the Oval Office, that flexibility will be key to keeping the economy healthy. Yahoo Finance's Jennifer Schonberger sat down with Richmond Fed President Tom Barkin to discuss the incoming president, tariffs, rate cuts, and more.
Tom, thanks so much for joining me. It's great to have you back on the program.
Glad to be here.
This week, we got new readings on consumer and producer prices that did not show progress towards your 2% inflation target. The consumer price index holding steady on a core basis at 3.3%, the same level since September, up a tick from this summer. Producer prices also similarly warmer. Fed Chair Powell says he now expects an uptick in your core PCE preferred inflation gauge for the month of October. Does the stickiness of core inflation signal that inflation risks getting stuck above your target?
Thanks. So maybe I'll talk about the data and then also what I'm hearing in the marketplace. On the data side, I've always expected that the last half of this year, core inflation would stay flat, somewhere in the high twos on a PCE basis. And the reason for that is that the reads last year were so good in the second half of the year that the comps were just very difficult. And so the numbers are coming in, they're about where we expected. We may get some good news in the first quarter of the year because you'll remember the first quarter was not very good from an inflation standpoint. I am still seeing progress, and where I'm seeing it most is when I talk to people. And the way I'd put it is this: consumers have been frustrated by high prices for a while, but they're finally acting on it. They're buying on promotion, they're trading down, they're going to lower price outlets. You can look at earnings reports of the everyday low price guys and you can see it. Consumers are making choices, and those choices are sending messages to price setters that their pricing power has just gotten limited. And so I'm seeing that roll out as I test with businesses what they're planning for the first quarter in terms of price increases. I'm not hearing the kind of inflation we've seen in the past. And that gives me hope that as we get through the first quarter, those numbers will come down.
So it sounds like going into next year, do expect inflation to come down from this sort of sticky core level that we've been seeing right now?
It's my expectation and it's my hope. Trust but verify.
Of course. President-elect Donald Trump has pledged across the board tariffs 10% on all U.S. imports, 60% on all Chinese imports. Do you see tariffs as a one-time reset in prices, or could there be ongoing longer-term inflationary effects that would cause you to rethink the battle with inflation?
We have a researcher on my team who wrote a great article on electoral uncertainty, saying you think election uncertainty is about the candidate, but it's actually more about what's the agenda actually going to be, as opposed to what people have talked about, and then how much of it gets implemented. And I think we're a long way away from knowing what we're going to have in tariffs, how big they're going to be, whether we have retaliation or not. And so it's awfully hard to know what the impact is on inflation. Obviously, if you increase the cost of goods coming in the country, that cost will, at least in some part, get passed on, but a lot depends on what we've got, how long it lasts, what the behaviors are on the backside, and it's just hard to make a call on that.
How are you viewing the strength in the job market now?
Hiring levels down to 2014 levels. People are managing headcount down largely through attrition, but they're also still being very cautious on laying people off. You saw initial claims yesterday, still very low, and so it's a low firing environment. That doesn't feel to me like a long-term equilibrium. It feels to me like either people are going to end up, trusting demand, finding that they're short-staffed and hiring again, or feeling the margins compressed and starting to lay people off. In my conversations, that's why I then push on, are you planning layoffs? And I have to say, you're just not hearing it at any scale. And it takes time to plan a layoff.
Right. So given your sentiments on inflation and the job market, how restrictive do you think you are right now?
I think we're restrictive enough. The whole notion of what the neutral rate is one of these unobservable variables that people look for in the forest and can never find. And so I think you have to sort of see how restrictive you are by what's happening in the economy. I do think inflation's coming down. That's a sign we're restrictive. It's just hard to know whether we're somewhat restrictive, a little bit restrictive, very restrictive. And you've seen in the SEP the broad range of estimates of me and my colleagues. We'll just have to figure it out as we go.
Yeah, I guess to follow up on that, I mean, how restrictive do you think you need to be in this environment and going forward, given your outlook?
Well, I'd like to get inflation sustainably down to 2%. That's the core of being restrictive. I don't think we have to be as restrictive as we were, 3 or 4 months ago. That's why I voted for the last 2 rate decreases, because I think we can recalibrate rates to a somewhat less restrictive level and still have the impact we want to have on inflation while having somewhat less impact on demand.
What would cause you not to cut rates in December?
There's so much that's going to happen between now and then. I let the data come in. We've got the option value of allowing it to come in, and then we'll have a good discussion to make a call.
Treasury yields have backed up some 90 basis points since you first cut rates in September. You've cut rates by cumulative 75 basis points. How does that work into your calculus for setting rates, and does that complicate your job?
Well, I thought you were going to say, why has the yield curve been inverted for so long? And now it's finally uninverted. So we'll take that as some good news. Look, rates came down significantly during the summer, I think, in anticipation of what was going to happen. Since we first started cutting rates, I'd say the data's come in. The demand data has certainly come in stronger. There's a lot of conversations going on about what next year might look like. And most people, I think, are moving toward the demand might be healthier than I'd otherwise thought. And, that's probably got some implication too. Maybe fiscal's playing a role. Most people don't understand. We control the short end of the curve. We don't control the long end of the curve. And there's a lot of factors going on there.
Joining us now with more is Jennifer Schonberger, who of course conducted that interview. And you spoke to him for longer, but I'm curious sort of what your takeaways are overall from the conversation.
Thanks, Julie, and my big thanks to Richmond Fed President Tom Barkin for coming on the program today. Three takeaways here. One, I thought that Barkin was initially in sort of inflation is sticky. It may take a little bit longer here. There's a risk of inflation getting stuck, but clearly he believes that inflation is going to come down as we go into the first quarter of next year. He actually sees PCE coming in at 2.4%. And Fed Chair Powell has said that, we're going to get 2.8% on core PCE come October. So, and part of that is because he's hearing on the ground that businesses don't have the pricing power that they used to have. Secondly, and we didn't show this in this clip, folks may have to go to our website online to see the full piece, but he seemed to hint at slowing down the pace of rate cuts. I asked him, given the strong economy, given the retail sales we saw today, there seems to be strong demand in this economy. And so does that make him think about slowing down the pace of rate cuts? And he said, well, there's two phases to cutting rates. One is recalibration, which is what they've done the past two meetings. And the second is normalization. And as they get towards normalization, he says the Fed needs to move more carefully. And then lastly, I would just note that I asked him about the uptick in Treasury yields and if it created enough volatility, whether that would cause the Fed to stop their balance sheet runoff. And he said the uptick in Treasury yields was not really going to be a determining factor in stopping that balance sheet runoff.
Yeah, and that's kind of similar, I believe, to what you heard from Neil Kashkari the other day when you spoke to him at Yahoo Finance Invest as well. So interesting to hear that unified front. Our Jennifer Schonberger, thank you so much. And as Jen mentioned, viewers can find that full conversation with Richmond Fed President Tom Barkin on Yahoo Finance's YouTube page. We're just getting started here on Market Domination. Coming up, pharmaceutical names continuing to slide after President-elect Donald Trump named vaccine skeptic RFK Jr. as his pick for health secretary. More on what healthcare analysts are making of that move is coming up. Plus, we'll take a look at some of the biggest trending tickers and movers on Yahoo Finance's trending tickers page. And another edition of our series, Goodbye or Goodbye. We're going to Japan for this one at 3:30 p.m. Eastern, one of Warren Buffett's favorite places to look for deals. Stick around, much more Market Domination still to come. Fed Chair Jay Powell saying this week the central bank is in no hurry to cut rates given the strength in the economy and persistent inflation pressure. Expectations for inflation's path forward have been less certain, partly due to uncertainty over what President-elect Trump and a Republican Congress will end up enacting in terms of tariffs and tax cuts. Glenn Hubbard, Columbia University Russell L. Carson Professor of Economics and Finance and former economic advisor to George W. Bush, is joining us right now. Glenn, it's great to have you here and to have your thoughts on what could be ahead, because there's a lot of uncertainty surrounding it. But I do want to take the Fed picture first with you, because we've been hearing from a lot of Fed officials who are making it sound as though a December rate cut might be in question, in part because inflation's been sticking around. First of all, sort of your high-level thoughts on that scenario.
Well, inflation is sticking around. The economy is in good shape. And of course, we don't yet know what President-elect Trump's economic plans will be. I think there's an argument for the Fed to pause, but the Fed could well cut. I think what's more certain is that the pace of rate cuts is likely to slow. It's very hard to believe we're going back to a very low rate future.
Do you think, Glenn, if the pace slows or even pauses, does that set up some tension between the Fed and President-elect Trump?
Well, I think it depends. The president-elect has lots of levers. I'm actually quite optimistic for good policy on tax, on regulation. You know, monetary policy is not the only game in town. The Fed's job is principally to watch out for inflation, and I think that's what's on its mind.
Let's talk more about that fiscal policy then, because you recently wrote about some of your suggestions in addition to the extension of the tax cuts. We've been getting a lot of news from the incoming Trump administration about some potential cabinet picks. We don't yet know what the economic team is going to look like. Have anybody on your wish list that you think is going to help enacting the sort of best case policy here?
I'm sure the president will make good appointments. The key is the president himself and Congress getting behind it. As you said, on the tax front, there's a lot to be gained by extending some pro-growth policy on investment, particularly bringing back expensing. I hope he'll focus there.
Glenn, and flush that out a bit more, because you did write this op-ed in the Journal. It was this week, Glenn, in which you talked about how you think Trump could encourage stronger growth. Walk us through some of those policies as you see it that would help him deliver on that.
Well, sure. What I referred to in the piece was the possibility of an awakening, that is, bringing together traditional ideas that conservatives like President-elect Trump have had with more inclusive ideas. So on tax policy, focus on growth, go for expensing, but also focus on research, basic research, applied research centers around the country. But don't forget two other things traditional conservatives have often forgotten, which is opportunity and participation. And I think President-elect Trump talked about those very well in the campaign. So I'd like to see plans to encourage work, improvements in the earned income tax credit, for example, aid to places that are left behind, and ways to help people stay engaged more in the economy and society. I think he's got a real chance to do that. But the first step up will be the tax bill, because that's got to happen quickly.
Glenn, as sort of a classic conservative here, I'm curious how you're thinking all of this is going to get paid for, because, we saw some of the, for example, deficit projections under the two presidential candidates, and they were actually substantially higher under President Trump's scenario, in part because of the tax cuts. How do you sort of cope with that?
Well, it's a great question. I think that the deficit problem facing the country is significant and serious, and likely to become more so. We're going to need to spend more on defense. I'm sure the president and the Congress will agree to that as well. There are ways in the tax bill to not lose as much revenue as some of the forecasts suggest. There are ways actually to encourage firms to do more business in the United States and lose less revenue. So I think the president's team knows this. I don't expect the tax bill to be a huge blowout to the deficit.
And Glenn, speaking on this same theme then, this new Department of Government Efficiency, Glenn, run by Elon Musk and Vivek Ramaswamy, how optimistic, how confident are you about that?
Well, I think it depends on what the remit turns out to be. Is there room to improve efficiency in government? 100%. I would start by approaches to regulation, things like permitting reform. There's a real question of why can't we build more and build faster in this country again? I'm a little more skeptical on the budget, largely because the biggest components of the budget are Social Security, Medicare, defense, and interest payments. Don't see much of an appetite for cutting there. But in terms of improving efficiency in the government, there's a big scope.
There's a big scope, and I mean, we've heard some people talk about, a wholesale change that could be brought about by the approaches of guys like Musk and Ramaswamy. But, as somebody who's been in government, is it more just a matter of sort of chipping away at inefficiencies here and there than the possibility of being able to do something of that scope?
Yeah, I think it's chipping away, but it's also coming up with a better process. How do we make sure when we evaluate regulations that we're looking more at costs and not just benefits? How do we make sure that we're able to build faster and better in the country? It's not incredibly page one headlines for most of the public, but it's super important in how government works. So I hope the president and his new team will focus there. Let
me ask you, Glenn, if President-elect Trump, maybe he read that op-ed, he came to you, Glenn, he said, listen, Glenn, I'd like you to join the administration. We seem to be aligned on some policies. What would you say, Glenn?
I'm not expecting such a call, but I think every American ought to help the president however he wants.
Glenn, always good to have you on the show. Thank you so much for joining us. Crypto is top of mind as investors brace for a second term from President-elect Donald Trump. Our next guest says a strategic Bitcoin reserve is important for Trump to get done in his first 30 days in office. For more, we're bringing in Anthony Pompliano, founder and CEO of Professional Capital Management. Anthony, always good to have you on the show. So, you look at Bitcoin here, Anthony, obviously a ton of excitement since Trump's victory there. Bitcoin's up about 30% now since November 5th. How do you make sense of these moves, Anthony?
Yeah, I think that people are very excited. It's obviously the first time we've had a pro-Bitcoin president take into the White House. And so the market believes him. The market believes that President Trump is going to do what he said. And so anytime that the market believes that somebody is going to fulfill campaign promises, it begins to allocate capital. It's not going to wait for him to make the moves and then they'll allocate capital. They're trying to position themselves ahead of it. And I think that the Bitcoin Strategic Reserve is a very important thing for America, but it also will signal that these were promises made and promises kept. And I think that that is something that President Trump should do very quickly so that we don't get front run by other countries.
Anthony, I don't think any countries except for El Salvador are jumping into the Bitcoin reserve game just yet, or at least they haven't said they are. And even President-elect Trump, it is not clear if that strategic reserve would just hold the Bitcoin that the government already has or buy new Bitcoin. The latter would be a much more sort of controversial move and perhaps counterintuitive since the strategic reserve of dollars is the world's reserve currency. So, I mean, how likely do you actually think it is that the U.S. government's going to be buying it for that reserve?
Well, so there are a couple of other countries that maybe are not as well known, but for example, the country of Bhutan has about $1 billion of Bitcoin on their balance sheet. But these are small countries, right? They're not kind of susceptible to the innovator's dilemma. They have the ability to do this because there's not a lot of risk. They don't have a huge economy that is put kind of in place. And so I think when it comes to the United States, yes, holding the Bitcoin that we already have is kind of a no-brainer, but buying it is also very, very important. There is a global race for Bitcoin going on right now. And whether you are a local, state, or federal government official, you should be figuring out how to get as much Bitcoin onto the balance sheet as possible. This is not like gold where we can just go dig up more of it out of the ground. This is not like other assets that can be created out of thin air. There's only 21 million. And on the off chance that Bitcoin ends up actually fulfilling the promise of Bitcoin, we're going to want to hold as much of it as possible. And so we're not talking about large amounts of money. I mean, the national debt increased by $850 billion in the last 90 days. If we were to try to put that same $850 billion into Bitcoin, that is about half of the current market cap. And so we're talking about $50, $100 billion. That's small numbers, rounding errors when it comes to the government spending. And I think that it is well worth the risk reward.
Anthony, besides policy, I think you could expect personnel changes here. President-elect Trump has made it very clear how he feels, of course, about SEC Chair Gensler. Any candidates you'd like to see running the SEC? Anthony, any bets you'd place there?
No, I think that whoever it is will be somebody who's smart, prudent, and hopefully pro-crypto.
Anthony, some of the commentary I've seen has suggested that whatever policy the SEC ends up taking towards crypto could actually be more beneficial to altcoins as opposed to Bitcoin. I mean, Bitcoin after all, at this point, is pretty accessible in a number of different ways, not necessarily so with the altcoins. Do you agree with that take?
I think that Bitcoin has the most regulatory clarity already. And so if there is an increase of regulatory clarity, it naturally is going to flow to other assets. Obviously, Ethereum also has an ETF that is approved, but I expect Solana and many others to get approved over time as well. And so, Bitcoin is kind of the big winner so far. I think it will continue to be the king of the industry, but it does have the most regulatory clarity. That's been a huge boom and tailwind for the asset. But that same regulatory clarity, I think, is coming for other assets over time as well.
Anthony, we talk so much about the Trump victory, but Ohio is sending its pro-crypto candidate Bernie Moreno to the Senate as well. How important do you think that was as well to sentiment here?
Well, I met Bernie Moreno well before he ever wanted to be a politician, and he was pretty pro-Bitcoin at that time as well. I think he believes in, fundamental rights like the United States was built upon, and so it's great to see him kind of put into that position of kind of governance. And I really just think that this is a complete mandate. The American people spoke. The last time that a Republican won the popular vote was quite a while ago. And so anytime that you have such consensus from the American people, the people that we are putting into these positions of governance hopefully will go and fulfill that mandate. And it's important that they remember what they promised, because that's why people put them into these positions. And so now it's time to kind of just go execute. Stop with any of the divisive politics, stop with kind of the competition of campaigning, and now it's time to govern. And let's go and actually affect the change that was promised.
Anthony, we've seen, of course, all of the cycles in Bitcoin prices. While certainly could have much more upside from here, what do you think is the biggest risk right now? What's the thing that's going to trigger the next crypto winter?
The biggest risk for most people is that they don't own enough Bitcoin.
Because come on, Anthony, that's not what I'm asking you. I'm asking you, what is the biggest risk to price action?
No, again, I think that is the biggest risk, because if people aren't holding Bitcoin as a portion of their portfolio, that means that they have 100% of their wealth allocated to dollars or dollar-denominated assets such as stocks, et cetera. And in our country, there is death, there's taxes, and there's the national debt is going to go up. And so Bitcoin is a proxy for currency debasement. The U.S. dollar has lost 25% of its purchasing power in the last 5 years. 50% of our country has 100% of their wealth in dollars. It's a national crisis. 50% of the American citizens had 25% of their wealth stolen from them silently. They have no clue it happened. We have to educate these people. It's a financial education gap. An asset like Bitcoin is a digital savings account that helps protect them against that currency debasement. There's many other assets that they can also put into that investment portfolio, but holding too many dollars is the biggest risk in a world where the national debt going up and the currency being debased is all but guaranteed.
Anthony, always good to have you on the show. Appreciate your time and insight, sir.
Absolutely. Thanks for having me.
And coming up, it's the latest edition of our series, Goodbye or Goodbye. We're taking a deeper dive into two stocks to help you make the best moves for your portfolio. Stick around, much more market domination still to come.
It's a big, noisy universe of stocks out there. Welcome to Goodbye or Goodbye. Our goal to help cut through that noise to navigate the best moves for your portfolio. Today we're looking at the investment potential in Japan amid the country's improving corporate governance. I'm here with Hennessy Japan Fund Portfolio Manager Masa Takeda. Thank you so much for being here. Appreciate it.
Thanks for having me.
So let's get straight to the stock that you like here. It's called ORIX. It is the largest diversified financier by market cap in Japan. We've seen the stock do pretty well this year. We've seen it rise about 26.5%. So let's talk about why you still like it here. And first of all, has to do with tourism to Japan. We actually have a chart of what we've been seeing here. We had a sort of peak in the late teens, and then it's coming back up towards that level right now. Why is that good news for them?
Right. So you might think, because it's a financial services company, why is it a beneficiary? Well, so they have three segments that that have been benefiting in a big way. One, they are the owner of Kansai International Airport. So they're an investment company, so they own these crown jewel assets. That's a monopoly business. Number two, they're in aircraft leasing business. Avalon and ORIX Aviation combined, they are the third largest in the world. And it's a wonderful time to be aircraft leasing business. And then thirdly, they run hotels and they own hotel properties across Japan. Again, inbound tourism, the business is thriving. So, I call them hidden beneficiary of Japan's inbound tourism.
Right, because as you say, you wouldn't necessarily think a company in finance would be connected, but because of that assets, those assets. Also, of course, Japan, the Bank of Japan has been normalizing rates. Talk to me about what that does for ORIX's investments.
Sure. So this is a financial services company by origin. So they started as a leasing business, and then they branched into lending business, life insurance, private equity, private lending, and so on and so forth. And these are obviously beneficiary of rising interest rates. We talk about rate hikes in Japan, but that sounds a little bit too hawkish. In fact, it's all about normalization of interest rates in Japan. And this is a nice tailwind for these types of businesses that have suffered for so many years.
Interesting. And then finally, even though the stock has been up as we looked at, the valuation to you still looks attractive. What valuation metric are you using?
Well, so I think the easiest metric you can look at is the price to book, and even based on reported BPS, price to book is touched below 1 times book. Now, the company, being an investment company, they have a lot of unrealized gains on assets on the balance sheet. Some of them show up in the balance sheet, some of them don't. Some of them don't show up. So on the market value based book value per share, their price to book is far less than 1 times right now. P multiple also 10 times or less than 10 times. Dividend yield 4 times. I think it's a very, very attractive valuation.
Interesting. So we always like to point out what could potentially go wrong or what's a risk. And that would be if there's a global recession, because it would sort of pull down some of these investments along with it. What do you think the likelihood, though, of that is at this point?
Well, obviously, there's always unknowns, but, anything financial is always sensitive and vulnerable to exogenous events. And so, of course, ORIX is not going to escape that, although we would see it as a potential buying opportunity. The other thing is, if the rates will continue to remain high in the US, they have some US operations, one of which is mortgage origination. And so, housing demand could be dampened if the rates continue to creep up.
Gotcha. So we'll keep an eye on that. And then the stock that you're saying folks maybe should avoid here is Hitachi, a name that is a little more familiar to U.S. consumers. It's a conglomerate that owns electronics, makes electronics, for example. Now, this stock has just about doubled over the past 12 months. And so one of the reasons that you don't like it as much is because all of that capital has flowed into it?
Correct. So we're shareholders. We invested back in 2021, saying that it was trading at 10 times PE with return on equity to 15%. And it was back then regarded as cheap manufacturing conglomerate. But our argument for this name was, this is a company that is starting to focus on transitioning from traditional hardware sales model to solution provider model. And this company has IT expertise, and they have operational technology. So they run mission-critical social infrastructure, and they also have manufacturing expertise. There are not a lot of companies out there with all these three types of expertise under the same roof. Now, 2 years, 3 years fast forward, now it's become everyone's favorite, so it's less attractive for sure.
Yeah, less of that sort of hidden jewel, I guess. They have a large backlog, as you pointed out to us. How does that then translate into revenue and profits?
So seeing a huge backlog, is encouraging. But then, of course, engineering. If you're an engineering company, EPC company, history is rife with cost overrun. So it'll be interesting to see whether they can successfully translate that backlog into solid revenue growth and profit growth.
And then finally, you talked about that transition that they've been trying to make. How has that been going, and how quickly has it been happening?
So again, our argument was initially it was going from manufacturing conglomerate to solution-based provider. And now the pace of that transition, of course, it remains to be seen. So far, so good. And I think if they continue to focus, if they continue to go in this direction, naturally the returns on capital should improve and cash flow generation should improve as well. And that should be good for valuation matrix. So, we expected multiple re-rating, which happened, and now it's got to a point where we think it's fully priced in.
Gotcha. So what could change if the stock does correct downward? Maybe that would be a reason to get in, or if you got a little more clarity on that transition, perhaps.
Absolutely. This is a name that we absolutely want to buy again if valuation becomes sensible.
Gotcha. Do you still hold any of the shares?
Yes, we do.
Okay, you just wouldn't be adding at these levels. Gotcha. Masa, thank you so much for coming in.
Thank you.
Interesting stuff here. Thank you so much for watching Goodbye. We'll be bringing you new episodes at 3:30 p.m. Eastern.
All right, now time for some of today's trending tickers, and you can scan the QR code below to check out the best and worst performing stocks of the session on Yahoo Finance's trending tickers page. Let's start here with Bloom Energy shares, and they are moving higher today. Look at that surge, actually surging the most ever in intraday trading for this name. It's coming after American Electric Power, said it would use the company's fuel cells to supply data centers. I did see analysts at Susquehanna saying, in their opinion, this is a significant win for Bloom, opens the way for additional large utility level agreements, they said.
Yeah, a really interesting move here. I mean, this is a heavily shorted name, and so we are seeing maybe a little bit of a squeeze. I thought it interesting, some comments from Julian Dumoulin-Smith over at Jefferies. He said he doesn't see much value to the announcement beyond the core 100 megawatts that was announced. And he says the reaction is overly robust to what is basically another key but not transformational incremental data center add. So he thinks perhaps this move is a little bit overdone.
60% is a little bit overdone?
Yeah, in a single day, maybe so. I mean, on the flip side, we see another company that's in a similar business, Fuel Cell, which is trading down today. That company announced some restructuring, some job cuts that it's doing, and so going in the opposite direction as Bloom.
Yep.
All right, let's also talk about what's going on in the metals space. Alcoa and Century Aluminum, they're on the move after Chinese officials announced they're going to end the nation's export tax rebate for aluminum and for copper. That move will be effective December 1st, raising costs for producers in the country, potentially tightening global supply chains globally for the metals. And so both of those companies, Alcoa and U.S.-based producers for a while have been concerned about the global trade picture and the effect that has on their businesses.
Yeah, so in other words, I guess the bettors could temper aluminum export demand from China. That is sort of the follow-through in the bet here, yeah. Remember back in the day, Alcoa? That used to be like when they reported, that was the start of earnings season.
It was the first one.
That was the firing gun.
Yeah, they're not that anymore.
All right, Palantir shares hitting a record high in today's trade. The move comes after the company announced it would switch its listing from the New York Stock Exchange to the Nasdaq. It'll begin trading on the new exchange, expected on November 26th there. So obviously, we continue to watch for good reason this week. So Palantir, I get the story here is, yes, it's going to the Nasdaq, but I think what investors are reacting to is Palantir saying, well, listen, we think we can meet the requirements of the Nasdaq 100 index, and that's what has people excited. Yeah,
it got into the S&P 500 earlier this year, and the stock has skyrocketed since then. In fact, this year it's up, something like 250%. Yep. And this even though there has been a flood of analyst downgrades. It's not that they don't like the company's fundamentals. Most of the people that we have talked to have said it is simply a matter of valuation, that the rocketing of the stock doesn't necessarily justify, isn't necessarily justified, even given some positive fundamentals for the company. But no matter what they say, it just keeps going up.
Bloomberg knowing the average price target actually now implies nearly 40% downside.
Wow.
So to your point, I did speak recently to CEO Alex Karp, and I brought that up. Plenty of skeptics, Karp. I said out on the street, they don't like the valuation, and he told me they have a consistent trajectory of being wrong, he told me. Every quarter, we keep having these results. So Karp, bold as ever.
Yeah.
All right, coming up, pharmaceutical names are continuing to slide after President-elect Donald Trump named vaccine skeptic RFK Jr. as his pick for health secretary. More on what healthcare analysts are making of that move. It's coming up next.
Now let's get to our call of the day, or really a collection of calls, as vaccine companies are feeling the pressure today. It's coming after President-elect Donald Trump saying that Robert F. Kennedy Jr. is his pick to lead the U.S. Health and Human Services Department. For more, we're bringing in Yahoo Finance senior health reporter Anjali Kamlani. Now, these stocks have been falling because, of course, RFK Jr. is a noted vaccine skeptic, but analysts are weighing in and saying, what is this really going to look like?
Yeah, what we're hearing from analysts is really a wait and see sort of strategy. We don't know what the policies yet are. We do know what RFK's stance has been in the past. He was notoriously dubbed one of the disinformation dozen during the COVID-19 pandemic, when he was identified as one of 12 people contributing to about 65% of misinformation on vaccines. He is one of those who is identified as linking vaccines to autism, which a large portion of the scientific community has pushed back on. And so what we're seeing is, he has some ideas. He's also pulled back from some of those comments in recent interviews saying he's not going to take vaccines away, if you will, but still believes that there is some level of unsafety or maybe some issues with the FDA and the regulatory process for approval. So that's where, everyone's taking a step back and saying, let's see what he actually has to say. We heard from JP analyst Chris Schott, who said it is difficult to evaluate the exact impact this appointment could have on the industry until we have more information on specific policy proposals. That said, we're not surprised that the sector has been under pressure given RFK Jr.'s stance. And of course, we've heard from others like Zeke Emanuel, who is a noted healthcare expert. He served on President Joe Biden's transition COVID-19 team. He said earlier today that while RFK Jr. has no management experience nor, understanding of how science is done, he does have some good ideas. And this is also something that we've heard from other members of potentially, picks for President-elect Trump's administration. That includes ideas about chronic disease as well as ultra-processed foods and the need for oversight in those areas. So people are saying, well, maybe they have some good ideas or at least have identified correct problems. Have to see what the solutions are that they present. Of course, RFK Jr., notably part of the very storied political family in the country. We've seen some of his family members push back against him and his ideas. So it's going to be interesting to see how it all pans out and what actually happens. There are some folks saying that a little bit of the reaction that we saw on Wall Street is an overreaction and just to sit tight until we know more.
One thing, Anj, I'm still trying to understand is how much real power and authority he would have if indeed the Senate confirms him. Does he come in and say, I'm not a fan of seed oils, and there goes seed oils? Is that how it works?
He could have that level of authority because he oversees all of the departments. As part of HHS, he has oversight of the FDA, of Medicare, Medicaid, the CDC, so disease control. What his priorities are will then result in where the resources go, and that's where we don't know the answers yet. There are questions about whether or not it will even be required to go through the full Senate confirmation hearing for this appointment. There's been some discussion about that, and that's why there's so much uncertainty around this. But the power that he does have in the role of Secretary of the Health Department is quite widespread and sets the tone for what the U.S. policy is. It's also important to point out that up until now, the U.S. has really set the policy, the gold standard globally for the FDA, for the CDC, and all that could also be thrown into question with his appointment, depending on where he takes the policies. There are also some who are a little bit more cautious about the power, saying that because these agencies are so large, it will take quite a large amount of time for him to really come in like a wrecking ball, if you will. I know that term has been used a lot for the potential picks for the administration. So that's also something to keep an eye on, is these large organizations or agencies rather that have existed for quite a number of years. It may take some time to really do some damage there.
All right, Anj, looking forward to that confirmation hearing. That could get interesting. Anj, thank you. Have a great weekend. Oklo is on the path to capturing commercial opportunities from the shift toward nuclear energy driven by the data center boom. The company is setting the stage for the fueling the AI power supply, however, pushing back its timeline to developing nuclear. Oklo co-founder and CEO Jake DeWitt joining us now to discuss. Jake, it's good to see you. I do want to start on the action we're seeing in your stock today, Jake. Listen, you pull back the chart. It's had a remarkable move, but today we are down and under some pressure here. I wonder, Jake, how much this has to do with details you shared, maybe, Jake, on the share lockup. What is going on there? Can you walk us through it?
Yeah, I think that's part of it. I think, look, at the end of the day, the stock's performed so well. The company's been doing so well that we had to do some regulatory disclosures because of the acceleration of some unlocks on some of the major long-term holders of the company. Myself and my co-founder included. Of course, that's we're not moving those shares or anything. So I think at the end of the day, there's kind of a lot of response to that. But generally speaking, it's a reflection of how well things are actually moving on this front and how well the company's been doing as of late.
Certainly there's a lot of enthusiasm, Jake. As we talked to you before, it seems to even have gotten to be more potentially. The timeline that you guys are now talking about for your first demo project, can you walk me through that and what has changed?
Yeah, I mean, really nothing. Where we're at is continuing to execute on the regulatory milestones. We had a couple announcements that span the last month plus that are sort of on the track towards what everything you need to have in hand to get a plant up and running and starting to produce power in late 27. We continued to execute well with pretty significant capital efficiency. When you look at the nuclear space, typically things spend a lot of money, and that's kind of the normal part of the founding thesis we had at Oklo is you don't have to do that. Nuclear does not have to be costly and expensive in those ways, and we're validating that, right? Having about 1/5 the cash out the door compared to our competitors and making significant progress. So at the end of the day, we're on a good trajectory for that first plant. But what's really kind of exciting, and it's one of the big things that just happened this week that I think on a Friday news cycle, sometimes folks a little bit forget, given we announced it a couple of days ago, just added 750 megawatts for data center powering on our order book. A pretty sizable development as we've scaled that up now to 2.1 gigawatts total. And look, like the pipeline is extremely active here. I mean, given all the activity going on in the space, given other energy sources announcing deals in the data center side, I mean, it's a really exciting time to be in this business. Just crazy amounts of demand coming forward, and we have a unique solution. It's really important.
Jake, we did not forget that you signed that additional deal for the additional letters of intent. No, I was going to ask you about it actually, because you did not name the customers in that particular case. Can you give us a hint? Or I'm just curious because when you don't name those customers, what's the sort of strategy? Why are some of these maybe AI data center owners or whatever they are, why do they not want to tip their hand and let people know that they've signed these letters of intent?
Yeah. Well, I just had to bring it in, of course. So I'm glad we got to that. But no, it's an interesting dynamic. I think what we're seeing emerging as of late is the nearer term power deployment opportunities that we're really working to fill in, not some of these real long-term things, but these near-term dynamics are really impacting one of the most significant strategic assets that data center developers are limited by, which is power. And we bring that solution forward in a way that really works for them, given our business model, right? We just sell them the power. They tell us where they're going. We bring it there. We sell them power. It's a unique differentiation from kind of what's otherwise out in the nuclear space. And what we're finding is that's worth a lot strategically to these customers. And so they don't necessarily want to get out there and tip their hand, given what this helps them do in terms of their development plans at this stage. And we respect that. We get that. We're happy to be adding something of such significant strategic importance in a near term. But that said, these things all develop in time and progression. So we expect, those to continue and ultimately sort of more details to come forward as those basically continue to maturity and ultimately commercialization. But I think we're seeing a lot of strategic kind of, I would say, maneuvering on behalf of some of our customers about what they see as the value of what we're doing here and wanting to kind of keep that close to the chest because of the advantage they see it gives them. We appreciate that because it begets more business, but it will also ultimately come to bear as these things execute towards, turning these plants online, turning the data centers online and actually providing power.
Jake, Vivek Ramaswamy, of course, along with Elon Musk, heading up our new Department of Government Efficiency. Here's what Ramaswamy posted on X this morning. I thought of you, Jake. He posted, too much bureaucracy equals less innovation and higher costs. That's a real problem with the FDA, Nuclear Regulatory Commission, and countless other three-letter agencies. What's your response to that, Jake?
I mean, it's pretty fascinating, right? That the NRC is one of the top named focus points here. I think what we see is we've had a lot of support from a bipartisan basis for nuclear in this country that spans back several administrations, and it's only increased, right? It increased from Obama to Trump the first time, increased from Trump to Biden. I think we're going to see it increase even more from Biden to Trump again. And I think one of the big focuses you're seeing out of this administration coming in, President-elect Trump really cares about driving, more development and unleashing the American economy and getting regulatory dynamics out of the way that are out of date. And so I think you see a lot of interest that's also supported on a bipartisan front of regulatory modernization and driving for more efficiency. And I think that at the end of the day, that's only going to be constructive for getting new plants built.
Jake, I'm curious about speed. In 20 seconds, do you think that you could see a move up in the timeline if there's significant regulatory change?
I think it's possible, especially if you couple that with some things the government can do to accelerate availability of fuel, something that there's a lot of interest in doing too, to kind of bridge us to commercial supply chains being fully functional. So I think there's some possibilities there that are pretty exciting. So we're exploring those and eager to see how those unfold.
Jake, always great to see you and have you on the show. Have a great weekend.
Thanks for having me.
We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.
There's the closing bell on Wall Street, and now it is market domination overtime. Let's take a look at where the major averages ended the session, sort of fading here as the day went on. The Dow finishing lower by 306 points, about 0.7%. The S&P 500 down 1.33%. So that means the tally for the week down about 2.1%, the worst week since early September. The Nasdaq also falling on the week and falling on the day here, off more than 3% on the week and off about 2.2% on the day. So really kind of a rollover here as investors are trying to figure out, are we going to see higher for longer when it comes to rates? Now, I wanted to check on Bitcoin as well, because not at its highs of the week, but climbing back in that direction. Now, on this session here, as you can tell from the weakness in the Nasdaq, it was tech stocks that took the worst of the selling here. The XLK, which is infotech, the XLC, communication services, and then healthcare. We heard from our Anjali Kamlani what's going on there with this appointment of RFK Jr., or nomination at least of RFK Jr. to head HHS. So that also one of the worst performing groups. Utilities, financials, and real estate. Perhaps strange bedfellows there, because financials tend to benefit when rates go higher, but utilities and real estate don't. So go figure. Interesting day, though. And finally, if we look at the Nasdaq 100 here, all of the Magnificent Seven lower, with the exception Tesla here up 3%, but pretty deeply in the red for the rest of the complex, Meta and Amazon in particular. Josh?
All right, Julie, the post-election rally fizzling out. The major averages closing the week with sharp declines. The market also once again focused on the future of rate cuts, as several officials suggest that a cut next month may not be a done deal. And joining us now is Charles Sizemore Capital Management CIO. Charles, it's good to see you. So what do you make of these markets, Charles? It seemed like the market, in some sense, anticipated a Trump win. We had that big move off the win. Now what?
Well, we saw that initial relief rally where I think the general consensus was this could get really ugly. There could be, not just proverbial, but literal blood in the streets if the election was really close. What happened was the election, of course, wasn't close. It was decisive. There was this relief rally as a result. There was also a rally in anticipation of lower taxes, lower regulation. You know the drill. What we're seeing now is sort of the hangover effect of what's the other side of a Trump presidency, a lot of uncertainty and potentially some very inflationary policies, of course, such as tariffs. And what we've seen is the Fed already trying to get in front of this. Jerome Powell, of course, made headlines by saying he was, and I quote, in no hurry to lower interest rates going forward. Market didn't like that. A lot of the bullishness we've seen in the market over the last several months wasn't just election related, of course. It was also Fed related, this perception that we hit a sweet spot. We conquered inflation and, rates go lower from now. Now all of that's in question.
And so, Charles, as an investor, how do you approach all of this? Because what we've kind of seen in the market this week is, as, for example, the various appointments have come out, we've seen investors selling first in particular sectors and asking questions later. Do you think it behooves investors to try to chase this, or should people just kind of be holding and waiting at this point?
I think you really need to pick and choose. So I think this market perception now that inflation is very likely coming back is true. It's really debatable if we really ever conquered inflation. I think the Fed, did a victory lap a little too early. Inflation's still running hot. If you look at core inflation, it's still over 3%. If you look at inflation in services, it's close to 5%. So the Fed really got ahead of itself by declaring victory a little too soon, starting to cut rates. I mean, they had that monster rate cut to kick it off. Then they had a secondary rate cut, 25 basis points. They may be done for a while. It's really debatable. The futures markets are starting to kind of price in the very real possibility that the Fed may be done, or at least really looking to slow roll additional rate cuts. So if you're looking to invest fresh capital, I would say beware of inflation. Look for sectors that are less susceptible to it.
We spoke to another strategist on the show this week, Charles, just to get your reaction to his take, because he sort of said, listen, while the Fed may be, not doing as much easing as the market was anticipating even just a few weeks ago, he said to him it was irrelevant, frankly. As long as the economy's strong and Jay Powell's not biased toward tightening, he didn't see much fire there. But what do you think?
Oh, no, the Fed is always relevant. It's been relevant, particularly ever since the pandemic. The Fed has taken on an outsized role. The Fed took on an outsized role in the FOMO rally during the pandemic. It took on an outsized role in the bear market of 2022, and it's taken on an outsized role ever since. So to say that it doesn't matter, of course it matters. Obviously, earnings matter more over time. But if you're looking at, how are those earnings priced, particularly if you're looking at tech stocks where you are valuing them today based on their earnings 10, 20 years out, that rate of inflation affects your discount rate. It affects what those stocks are worth today. And it's worth noting that those stocks came into this rally very expensive. The S&P 500 is expensive, and particularly the Magnificent Seven, particularly tech in general. We're starting at very high valuations.
And it's also probably worth noting that those stocks are down a lot today, right? That they are, that's where we're seeing the selling. One of the other trends that we have seen this year has been this big rally in utility stocks, because they are seen as benefiting from the need for energy to power those AI data centers. I know that's also a trend you're watching closely, but after the run that we've had in so many of those stocks, is there anywhere left to look that is also not overvalued?
Yeah, the utilities aren't necessarily the best place to look, because utilities are also really interest rate sensitive. Utilities forever and always have been priced as sort of bond substitutes. And And if you are looking at a period of higher interest rates for longer, then that makes utilities less attractive. What is more attractive to me is more the infrastructure side of it, looking at the companies that produce the turbines, gas turbines that produce the modular nuclear reactors. That's the way you want to play this, because the demand for energy is rising. It's absolutely rising. There's no way it's not going to over the next 10-year period here. That is about as close to a done deal as you can get. That's about as close to certain as you can get in this world. But utilities aren't necessarily the best way to play that because of their sensitivity to interest rates.
Charles, Nvidia earnings on deck next week. How important is that report to the market?
Well, it is going to be interesting because ultimately the market is driven by earnings and expectations of future earnings. So if the companies reporting have a somewhat dour outlook based on their perception of what higher rates, what higher inflation might do to their earnings over the next couple of years, that's going to weigh on the market. You're going to see analysts really digesting that. We'll see what they report, right? We won't know until they do, but what you're going to need to look for is any comments from management on how they're reacting to this possibility that inflation pops up again, how they see that affecting their earnings.
Charles, thanks a lot. Have a great weekend.
Thank you.
Well, let's talk more about this idea of reflation. The latest consumer price data shows inflation did tick up in October. While that alone doesn't provide a reason for concern, it does point to the potential for inflation to become worrisome again. Yahoo Finance's Rick Newman joins us now with more. Rick, we have been talking a lot about this. Of course, we've heard Fed officials comment on it as well. So what are you watching most closely here?
I'm watching economic forecasters who are looking more at the bond market these days than looking at the inflation numbers and basically reading into that new inflation expectations related to Donald Trump coming into office. So Capital Economics this week put out a note that said inflation could be back on the front page before long. And that's not just the 0.2 of a point increase that we saw from September to October. It's that Trump has these inflationary policies that would include tariffs, which are a tax that just drive up the cost of imported goods, deportation, which would remove some of the lower wage workers from the economy and I guess replace them with higher wage workers if it actually happens. The bond market is basically saying we think that is going to lead to higher inflation in the future, which is why even though the Fed is cutting short-term rates, long-term interest rates since mid-September are up 0.8 of a percentage point. And that affects mortgages, every type of consumer and business loan. And that's basically the bond market saying we think higher inflation is coming. Now, Trump has some control over this. I mean, he could signal, or when he takes office, he could indicate, no, I'm not going to do exactly what I said. But for now, markets are anticipating more inflation.
Is the bond market also, though, telling you, Rick, I mean, could also be responding to the economic data just keeps coming in better than expected? So October retail sales today and those upward revisions to September. And so the market is rethinking the pace of Fed cuts.
Yeah, unfortunately, the bond market doesn't issue a press release every day that says, here's exactly why interest rates read up. So we're examining the entrails here and trying to read the signals. Yes, that is definitely part of it. But a stronger than expected economy is also potentially reflationary, because then you have more spending than you might have had otherwise. You have workers in better shape. They're feeling like they have the money to spend. And, the Fed, I was puzzled when the Fed cut by 50 basis points in September. That seemed like more than necessary. And now they're doing quarter point cuts. But I'm seeing more economists now saying that 50-point cut was unjustified because it implied a weaker economy than we actually have. So, we're going to be talking about this a lot. The Fed might cut another 1/4 point in December, but that could be it. I mean, that would be a big change in market expectations, which have been 1/4 point cuts going at least into the middle of 2025. So, guys, think about what his reaction is going to be if the Fed actually starts to tighten up his policy, its monetary policy, just as he becomes president. We all know what he's going to do. He's going to rail on the Fed and on Fed Chair Powell for being tougher on him than they were on Biden in the home stretch of the election. We got a lot of fireworks to come here.
All right. Rick, thank you. Can't wait for the
Bye, guys.
drama. Appreciate it. Next, we are joined by the CEO of Plug Power to discuss the hydrogen technology company's recent quarter, plus what the future looks like for green energy names under a Trump administration. More market domination over time coming right up.
Earlier this week, Plug Power reported a miss on third quarter earnings and revenue. It doesn't look like as if the road ahead is going to improve at the moment for the hydrogen technology provider, with investors worried that President-elect Donald Trump's policies will not be as favorable to green energy as those from a Democratic administration. Joining us now, Andy Marsh, Plug Power CEO. All of that said, Andy, and welcome. You have said that you're working on finalizing a loan from the Department of Energy, and that you do expect to finalize that loan before the new administration comes in. Talk to me about that loan, what you're using it for, and your confidence level in getting it.
Sure. We start working with the Department of Energy on the loan under the President Trump administration. We're at the final stages, and we expect, and we've been in discussions with the administration. We expect it to finalize before January 20th, and that we have built the largest hydrogen plant for green technology in the world outside China in Georgia. And we're about to build one 3 times larger in Texas using some of this money, and to build 5 additional plants over time. So we're moving forward. And look, there's no one who's done what Plug has done in the hydrogen economy. We're known around the world. It hasn't always been easy, but what we've done is unique. We build real things for real people.
But Andy, to Julie's point, is there a contingency plan if that loan isn't executed? Then what?
So we do have, looking at equity partners at the moment, we have a process going on, which is far along in the process, and that is one opportunity. And look, when we look at the landscape, we have lots of activities going on in Australia, lots of activities going on in Europe with green energy. We've deployed more PEM electrolyzers in Europe than anyone else. At the Plug Symposium this week, we had a customer fly in from Australia to talk about the 3 gigawatt project that they're working with Plug on for green ammonia, and that could generate over $1.5 billion of revenue for Plug, profitable revenue.
Andy, one of the analysts who covers you guys talked about the potential for a flywheel that Plug could sort of create here. Talk to me about what you guys are, what that means, what the flywheel looks like, and kind of like what will optimize it, if you will, because investors aren't quite on board as of yet with that flywheel kicking into gear.
Well, I think we're uniquely positioned in the market because we have not only the ability to generate hydrogen and sell the devices that generate hydrogen, but we're also the primary user of our own hydrogen. We have large deployments with people using our fuel cells with the Amazons, the Walmarts of the world. So when you start thinking about it, as hydrogen becomes more readily available and that it becomes more of a ubiquitous fuel, you have the opportunity to use that hydrogen in our product, which customers buy. In addition to that, when you look at the energy generation side, we actually sell every part of the value chain, from the electrolyzers to the devices that turn into cryogenic, low temperature, so you can move liquid. We have trailers. We've built 300 fueling stations. Nobody's done that in this industry. Plus have deployed over 70,000 fuel cells. So having more hydrogen, I think it probably came from my friends at Roth Capital, actually means that we have more customers willing to buy our devices for using that hydrogen.
Andy, I was talking to an analyst who covers you all on the street today, and he was saying, Andy did a pretty good job getting his cash burned down in 2024, but could he do less than $500 million in 2025? What do you say to that?
I actually think we're going to do better than that. I think we will be significantly lower than 500 million.
And Andy, what do you feel like is the tipping point for all of this? We talk about you're talking about that bigger hydrogen adoption, and is it going to have to be catalyzed by policy, or do you think it sort of will be market driven?
I think it's a combination of both. I mean, I think if you're in the energy space, policy always matters. And even under, if you look at the production tax credit, which is under the IRA, there's been lots of reports that, the Trump administration will like, if the renewables, oil and gas, folks like hydrogen. So it's, we're kind of in a better strike zone. And quite honestly, the production tax credit, which was part of the IRA, the first regulations put out by the Biden administration, I've been very vocal that they didn't reflect the law. And that I think a combination of Loper, I think a combination and where they overturned the Chevron doctrine, elimination of the 3 pillars and going to where the law really was meant to be, could be a real accelerator of the hydrogen economy in the United States.
Andy, look forward to checking back in with you as all of this stuff sort of coalesces. Thank you so much. Appreciate it.
Thank you. Thank you for your time. Have a good day.
You too. Stocks tumbling Friday into a sharp weekly loss as a post-election rally faded. Joining us with some of today's top market takeaways, Yahoo Finance Markets and data editor Jared Blickery. Hi, Jared.
Well, hello, Julie. Let's do this at the table here
Let's do it.
and talk about some fund flows. This is going to be the Takeaways B of A edition because we are looking at basically $100 billion in cash. $100 billion went into cash. 53 went into equities, 6 billion into crypto, 2.8 billion into bonds, 1.6 from gold. So we got actual flows out of gold. But I just want to go over some of the markets that are seeing record highs right now, and then we can get to the heat map. Money markets, they have a new all-time high under management of $6.7 trillion. So that has just never been that high. That is cash on the sidelines waiting to come in. Everybody thinks, well, everybody wants to know what the trigger is going to be. We got to wait for that. Crypto record inflows. That was $6 billion. U.S. large caps, so the big guys in the U.S., record inflows of $44 billion. U.S. small caps, not a record inflow, but the largest since July 24. Talked about gold before. That was the biggest outflow in a couple years here. Utilities, biggest outflow since 2015. And then we have another materials record inflow. So if we go to the heat map here, I'm going to go to, I'm showing the Nasdaq 100, and I'm showing the last 10 days. Now, the flows data that I was talking about was on a weekly basis, and I believe it's Thursday to Thursday or Wednesday to Wednesday. This is just the last 10 days, so basically the last 2 weeks in the market. And let me go over to our sector action here. You can see energy was the biggest winner, up 7.6%, then financials, then consumer discretionary, healthcare, materials, leaders, staples, those were the laggards here. And then if we take a look at the leaders, and this is just to recap what has happened since the election, basically, Bitcoin, disruption, that would be the ARK innovation. Those were the biggest winners, along with regional banks and software. And then we did have some losers, cannabis, solar, gold, and also biotech.
Interesting. Your second takeaway, I love the sound of it, but I don't know what it means. Fed tide in 25. I like the, it flows
Yeah, it just flows,
off the
rolls
tongue.
off the tongue.
Yeah.
So here's what it means, and it's kind of scary for some people maybe. Fed doesn't cut in 2025. That's a possibility. That's a possibility thrown out by Michael Hartnett over at B of A. And some of the reasoning here, the dollar itself has been on a tear. Now, I'm going to go to the Wi-Fi Interactive. I'm going to chart this real quick. I'm going to show you the dollar and yields, which have been on the rise. And let me get, that's a 30-year bond. Let's just start there. I'm going to put a line chart on so we can see it a little bit better. The key level to watch is 5%, and that's a level we haven't seen in a while. I'm going to show you a max chart. We're going to go back to the 1980s. You'd have to go back to about 2007 to see a 5% print on the 30-year. And excuse me, that's actually going to be a little bit higher. But if we did get that high, that'd probably put the kibosh on this big rally that we're seeing right here. And the other thing is the US dollar index. The US dollar just came up to a multi-year high, and I'm going to plot that right here. And there we go. We can see it is right up against this high. It would be normal for the dollar to just come back down and do its thing here and be a tailwind for markets. But if it goes higher, and that would probably be concurrent with the 30-year going higher to 5%, that would present a real problem. What would this do? So no Fed cuts in 2025. Tariffs would be necessarily tempered. They couldn't be, Trump would not have the full tilt, the full availability of tariffs at his discretion. And then spending would be de-escalated as well, because the deficit matters, and we're talking about rates. If rates are too high, tariffs which add to those rates and push them higher, then we don't have that.
So added up, viewers, investors listening home, the takeaway is
2025 contrarian winners. Guess what? Emerging markets. Now, emerging markets, it's been a while since they have had their day in the sun, but we could finally see China and Europe come to the fore here. ECB may be cutting rates, and that would be in comparison to the US, just because America goes this tariff America first policy. ECB cuts rates, and then Europe outperforms. So does China, perhaps. Those have been two weak spots over the years where people have lost a lot of money, so that's why it's contrarian. And then gold. We have seen gold fall off so far, but if you look at what happened to gold in the 2016 election, I think that's really interesting. It took a downturn as soon as Trump hit the office, as soon as he was, elected, and then when he took office in inauguration, it went up.
All right, we'll be watching. Jared, thank you. Time now for what to watch next week. Starting off on the earnings front, all eyes are on, of course, Nvidia, the last of the Magnificent Seven to report this quarter. The AI juggernaut announcing results for its third quarter after the close on Wednesday. Nvidia eclipsing Apple in total market cap this quarter, making it the highest overall in the U.S. Next week, giving us critical insight into the AI landscape as we saw a bit of a sell-off in big tech to end today's session. Analysts expecting another big quarter for Nvidia's data center business, and we'll listen closely for any updates on its upcoming Blackwell chip. We'll also be getting some big retailer names reporting next week too, with Walmart, TJX, and Gap.
Taking a look at the Fed. More Fed officials making the rounds next week. This coming after comments from Fed Chair Jerome Powell yesterday. Powell saying the economy is not sending any signals that the central bank needs to hurry to lower interest rates.
And moving over to housing, monthly data for housing starts and building permits coming out on Tuesday. Economists forecasting housing starts to dip slightly to 1.34 million, while building permits tick up to 1.44 million.
That'll do it for today's Market Domination Overtime. Don't go anywhere. On the other side of the break, it's the best of Yahoo Finance's second annual Invest Conference. You can scan the QR code below to watch interviews from that marquee event. Have a great weekend, everybody.